In the prior section, I introduced the determinants of both PBO and planned assets. These factors can change PBO and the fair market value of planned assets. In other words, they have impact on the balance sheet. As we know, the PBO is a liability, and this is an asset. In this section, I'm introducing their income effects. As we know, a firm can earn income and record them into two different accounts. One is net income, which is the bottom line of income statement. It is also recognized as realized earnings. The other we recorded as other comprehensive income, which is reported in the balance sheet, and it represents unrealized earnings. I talk about the difference between realized and unrealized in the chapter 2. Actually, the factors which have impact on both PBO and planned assets also have impact on realized earnings and unrealized earnings. In the balance sheet, I split stockholders' equity into three parts. Contribute capital. Earned capital includes two. One is retained earnings. The other is other comprehensive income. Basically, we report realized earnings here and unrealized earnings here. Depends on the impact of the factors. Their impact on the earnings will be reported into these two different accounts. First, service cost. The service cost represents the current value of the future benefits earned by the employee, which is a function of time. Service costs increase every year because employees keep earning their future benefits. And this item is persistent. So we reported increase in the liability and also increase in the pension expense. So the impact of service cost on the balance sheet is PBO increase. At the same time, the earnings decrease because expense increase. The next one is interest cost on PBO. We know PBO is an obligation. It will generate interest costs. And interest cost will be recognized every year. So the interest expense is also persistent. It increases PBO and also increase the pension expense. The impact on the balance sheet is PBO increase and retained earnings decrease. Prior service cost is a planned amendment which the firm grant their employee retroactive benefits. Prior service cost is just one time, temporary. It increases the firm's PBO, but its impact on earnings will be reported in the other comprehensive income. PBO increase, other comprehensive income decrease. The next one is the liability gain and losses on PBO. The PBO as a liability, its value is subject to the change of discount rate or the market rate. The actual PBO may not equal to the expected PBO. That will result in unrealized holding gains and losses on PBO. Because they are unrealized, we will report in the other comprehensive income. If there is a gain, so liability will decrease. A loss, liability will increase. At the same time, if there is a gain, the firm will recognize increase in the other comprehensive income. If there is a loss, a decrease in the other comprehensive income will be recognized. So the accounting equation is always balanced. See, the factors I introduced all have impact on the PBO, but their impact on earnings will be reported separately. It depends on the nature of the earnings. So this is also true for the fair market value of planned assets. The planned assets are generally invested in the capital market into different portfolios. So the planned assets will generate return. So the actual return can be reported as expected return plus unexpected return. Because unexpected return, by assumption, it is a fixed growth rate. It is persistent. We are going to report its impact on earnings into retained earnings. Because it represents a positive return, so it will decrease pension expense. So the impact on the income statement is when the expected return recognized, it increases the planned assets and also a decrease pension expense, or it increase retained earnings. Unexpected return can be fluctuate. So its impact on the earnings will be reported in other comprehensive income. So for the unexpected return, if it is positive, it will recognize as increase in assets. Then other comprehensive income will recognize as increase in other comprehensive income. If it is loss, it will decrease the fair market value of planned assets. At the same time, we recognize other comprehensive income decrease. So this is actually the assets gain and losses, which is subject to the investment portfolio, and the gain and losses here represents the unexpected return, which is determined by the capital market. Again, for different earnings, we treat them differently. Depends on their earnings persistence. Persistent earnings has greater earnings power. Next, I'm going to use an example. This is a simple example. Total 3 years. 2013 is the first year. Let's first focus on the changes in the PBO. At the beginning, there's zero balance of PBO. Service cost increased 50,000, and interest cost is determined by the beginning balance of PBO. So the interest cost is 0 too. Prior service cost is not available. So by the end of 2013, the PBO is $50,000. In 2014, the beginning balance is 50,000. There's another service cost. The beginning balance of PBO, 50,000, will determine the interest cost, which is 3,500. In this year, there is a prior service cost, so it will also increase the PBO. So the balance of PBO by the end of 2014 is 203,500. Year 3, 2015, the beginning balance of the PBO is 203,500. It will determine the interest cost, which is the product of beginning balance and 7%. Another service cost. Prior service cost is not available. So the ending balance of PBO is 267,745. In this example, the service cost is persistent, every year 50,000. Interest cost is also persistent, which is the product of PBO and the interest rate. Prior service is only temporary. Next, change in the fair market value of planned asset. Same as the PBO, the beginning balance is 0, and the return is determined by the 10% long-term expected return. So here we simplified this case by ignoring the unexpected return. So the expected return dollar amount is 0. In this year, the employer contributes $60,000. So by the end of this year, the balance of planned asset is $60,000. Next year, the return is determined by the beginning balance of the planned assets. So the expected return is 60,000 multiplied 10%. There's another contribution. So the fair market value of planned assets by the 2014 is 126,000. Next year, the expected return is the beginning balance of planned assets multiplied 10%. There is another contribution. So the ending balance of planned assets by the end of 2015 is 198,600. What we find is contribution is stable. Expected return is also stable, which is a product of the planned assets balance and the expected return, the growth rate. We will see the service cost, interest cost, and prior service cost all have impact on the balance of PBO. For the planned assets, the expected return and the contribution will have impact on the balance of planned assets. In the first year, because planned assets is greater than the PBO, so this year the firm is overfunded. But in the second year and the third year, fair market value of planned assets are less than the PBO, so they are all underfunded. Next, let's take a look at the impact on the income statement. In the first year, the service cost will be recognized as pension expense. No interest cost, no expected return, and there's no prior service cost, so no amortization, and no amortization of gain and losses. So the first year, pension expense is $50,000, which is reported in the income statement as a deduction. Next year, 50,000 service cost increase pension expense, interest cost increase pension expense, expected return decrease expense. So this will be 47,500 as pension expense in 2014. The third year, again, service cost increase pension expense, interest cost increase pension expense, expected return decrease pension expense, and the prior service amortization increase pension expense. So here I do not show the information, but this example told us the $100,000 prior service cost, which is reported here, will be amortized in 10 years. So each year the amortization is $10,000. In other words, the firm will recognize the prior service cost in the next 10 years. So the pension expense of 2015 is $61,645.